Hi, and welcome back. Let's talk about how financial instruments are recognized and measured at their initial recognition. At the time of initial recognition, a financial asset or liability is measured at its fair value. However, if the instrument is not classified as fair value through profit or loss, FVTPL, it's measured at fair value plus or minus any transaction costs directly related to its acquisition or issuance. For example, trade receivables that don't have a significant financing component are measured at their transaction price upon initial recognition. Now, let's discuss a key concept: fair value versus transaction price. Sometimes the fair value of an instrument at initial recognition might differ from the transaction price. In such cases, the entity must account for this difference based on specific scenarios. 1. If the fair value is based on observable market data, such as a quoted price in an active market, the financial instrument is recorded at its fair value. The difference between the fair value and the transaction price is recognized as a gain or loss immediately. 2. If the fair value isn't directly observable, the instrument is recognized at a fair value adjusted to defer the difference between the fair value and transaction price. This deferred difference is then recognized as a gain or loss only when it reflects changes in factors that market participants typically consider while pricing the instrument. Finally, if the asset is measured at amortized cost after initial recognition, it's recognized at this fair value on the trade date when the entity uses settlement date accounting. Thanks for tuning in.